This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Walmart says the unthinkable has started. And when you see what's happening at Walmart, you're going to understand why the U.S. economy is in far worse shape than the political elites and policymakers want us to believe. And yet, at the same time, we're seeing evidence that the global economy continues to contract, while over in Germany, their economy is facing an unforeseen problem. And as they head into a depression, many have hoped that they're going to be able to turn this around. Well, based on what's happening now, there's no chance the German economy escapes the worst case scenario. And speaking of the worst case scenario, the U.S. labor market finds out that it's facing an unprecedented challenge that suggests again the U.S. economy is nowhere near as good as everyone believes. And besides all of that, one political elite says he's got the answers for everything, and we're going to show you why he's completely wrong about it all. And with that, let's over to Bloomberg, where we picked today's story up with a headline: Japan's exports decelerate, keeping pressure on the fragile economy. And one thing that's important to understand is we are in a globally synchronized economy. And so what you want to see is demand coming from around the world. So when countries, particularly like Japan, which are heavily reliant on exports, see a decline in them, well, it suggests that the global economy is indeed weakening, which is a case we've been making outside of the fact that what you hear from all of these central bankers and other political elites is that the global economy is just experiencing a soft patch on its way to a Goldilocks scenario where we get this soft landing and rebound, and yet we continue to see problems. And now let's take a deeper look at what's going on in Japan, because we're seeing in the headline here, global trade seen remaining on sluggish trend, at least for the time being. Well, that trend's not changing. Even their shipments to China fell, which is in dangerous position because many have pinned their hopes on a recovery out of China. Meanwhile, the value of exports gained 1.6% from a year earlier, slowing from a 4.3% increase the previous month. Economists thought that we get a 1% increase, so we did come out a little bit ahead of that, but still the trend is lower. Shipments were pushed up by a solid gain in cars, especially to the U.S., but gains were limited by continued double-digit declines in chip-making gear exports. So here again, you see external demand from around the world declining. Now, exports of cars to the U.S., it kind of makes sense because what was happening is we had the UAW strikes. So this was an opportunity for other manufacturers to attempt to flood the U.S. shores with vehicles, hoping to give enough supply to those who are looking to buy a car. But yet, despite all of that, we continue to see a slowdown in the global economy. The slowing exports suggest another source of uncertainty for Japan, and not just Japan, but the rest of the world, at a time when sticky inflation and limited wage growth are keeping a lid on domestic demand. Well, I'll tell you what, if you have limited wage growth, you're not going to have sticky inflation much longer. In the third quarter, business investment dipped while consumer spending failed to recover, resulting in a deeper expected contraction for the Japanese economy. Now, what's interesting, of course, about Japan is they continue to, of course, run fairly loose monetary policy. They try to let inflation run hot. And despite all those attempts, what do you see? Lower than expected wage growth. And then we see spending failing to recover, all a sign that, of course, that the U.S. consumer, the Japanese consumer, everybody around the world is dealing with the same problem. Not enough wage growth to keep up with inflation, and still not enough demand. And that's why we see exports continue to fall here. As we look at the U.S. data of exports of U.S. goods and services, and why does this matter for Japan? Because you hear this notion of sticky inflation, and inflation is not going to stay stuck too much longer, because I want you to notice a relationship here between exports and the consumer price index, both shown on a year-over-year rate of change. And it's pretty obvious where exports go, inflation follows, and sure enough, exports are on the way down here. We can see them in the negative territory, leading the consumer price index lower, and that's the same thing that's going to happen for Japan. They're saying that inflation's sticky, but we know there's no way it's going to stay stuck for much longer. The U.S. economy is likely to slow down. Well, that's obvious, as we're going to make the case here later in today's show, though it won't contract. Well, I'm going to challenge that one too. Overall, overseas economies aren't in a favorable situation for exports, and I think things will worsen from here. Yeah, absolutely, that part is right. The global economy is in dire shape because what happened is global central bankers inverted money curves. They inverted yield curves. And in a debt-based economy, you need a constant creation of new money. And when there's a lot of debt, as we have now, and a lot of inflation, you need a whole lot more money created to deal with just not only the debt, but to maintain the growth rate. So when you constrict that, what happens is consumers just can't buy as much stuff. When they can't do that, exports fall and inflation falls, and next thing you know, we're facing a global contraction that many here say the U.S. won't experience. Well, this chart says we'll probably will. And here you can see exports of goods and services in blue against real gross domestic product in red, both on a year-over-year rate of change. And notably, you can see, and I've circled several times, when the U.S. economy entered a contraction, that's anytime the red line dipped below the horizontal black line. And now we're saying it's unlikely because we saw this transitory boost in GDP here. Well, notably, the next one likely to head lower, and we're going to probably face a contraction because it tends to be when you see exports contract for any meaningful period of time. And of course, what we just saw is that one expert say that they believe that exports will continue to fall. Of course, we agree with that completely, suggesting that the U.S. economy is indeed likely to face a contraction, particularly when we see what's going on in Germany. And you look at Germany's case, there are the industrial powerhouse of the European Union. If Germany falls, all the peripheral nations around them go down with them, and yet they're facing a problem they didn't see coming, and it's far worse than anyone thought. As the German house building is collapsing and could drag the economy down with it. Of course, I want you to be thinking about the U.S. and what do we hear about the U.S. housing market? That there's just unprecedented demand, that the builders just can't keep up with things. And no matter how high interest rates go, no matter how high home prices go, buyers are willing to pay any price to get a home. Well, that was the same story in Germany. And look how it's changed. As companies are canceling residential construction projects, order numbers are shrinking and the outlook for the industry appears bleak. And this means that over 22% of companies surveyed reported the cancellation of residential construction projects in October, a new record high. Meanwhile, 48.7% says there's a lack of orders, which compares to 46.6% in the previous month and 18.7% a year earlier, suggesting that what we know is true. It isn't an issue of higher interest rates, and yet that's what they're going to say, because in a booming economy, if you're seeing payroll growth and wage growth and opportunity, affording higher interest rates isn't the issue. But when money is tight and banks don't want to lend, well, real estate eventually goes. The situation will worsen next year when all order books are empty and developers are left with high-cost projects and demand that won't pick up quickly enough. Currently, many firms are relying on the backlog of orders, but the gap between current construction projects and the incoming orders is widening. This means a drop in 2024 becomes more likely. And this is the same case we're making for the U.S. And look, and with the construction industry being worth around 7% of Germany's GDP, such a decline could put pressure on economic growth. The same thing will likely happen here in the U.S. We will see continued demand for real estate continue to fall. It won't be a matter that people won't want to buy a home. It'll be a matter that they can't afford a home, because you're going to see what Walmart is telling us is going on with the U.S. consumer is rather dire. And then we have some other data that came out today that completely validates that the labor market in the U.S. is about to come crumbling apart. But let's start with the U.S. factory production as it falls as strikes drive 10% plunge in autos. Of course, this should be no surprise. We knew the strikes were going to have an effect on production, and output decreases 0.7% as the biggest drop since June. But one thing that shouldn't be dropping is your trading account. One thing I want to update you on is we had a trade that we showed on our reports to go to the long bond, to TLT. And many of you I saw in the comments said, no way this is going to work. Your reports are wrong, you're wrong, everything's wrong. Well, let's look at what the report said and look at how that trade panned out. On November 2nd, what did we see from our Momentum Timer Pro report? It had one daily buy count on the momentum signal, and what this report does is it looks at all those technical signals that everyone gets confused by, and it smooths them all out and tells you on a day-to-day basis, looking over a 1 month, 3 month, and 6 month period, what's going on with momentum. And on November 2nd, it put up a +1 on the daily. And then on November 2nd as well, what happened? TLT on our CTA Timer Pro report. This looks at machine positioning and mimics it, but we run an historical overlay. That's a big differentiator here. It came off that max short position, and that triggered what our most successful traders tell us. And I get emails from every day, people saying, look, I use your reports exactly the way you're saying. I'm making money, and it's fun. I'm enjoying trading. And look, you can too, because if you would have taken that TLT trade, you would have bought it open. Many of you said, no way, man. There's no way I touch a long bond. Well, a long bond's up 3.2%. And when you saw what happened on Sunday's show with the machine positioning, well, you'll know there's a lot of potential upside. I put 5 more coupon codes for a free month. Now, many of you are asking, Steve, I go there and there's no way to put the code in. That's because someone beat you to it. So you got to get it while they're hot. There are links in the description below. Output decreased 0.7% last month, the most in 4 months, weighed down by a 10% drop in motor vehicle production. But when you strip that out, manufacturing rose a mere 0.1%. So what that's telling us is U.S. manufacturing production is not in a major rebound. As we look at these Fed surveys that are telling us that new order demand is slowing, that backlogs are shrinking, what have we seen in the headline numbers from the government is validation that the U.S. manufacturing sector is not immune to the global downturn at all. And yet total industrial production, which includes mining and utilities, get this, fell a whopping 0.6%. And sure enough, all this means is the U.S. stock market is massively overvalued against industrial production. Here we have industrial production blue against the Wilshire 5000 price index in red. And there are a number of times where you see industrial production slowing here and the equity market rallying. And what happens? Equity market gets it wrong and heads lower. And you can see there's times they're in divergence. Equity market falling as industrial production is rising, and that's a catalyst for higher stock prices. As you can see there in 1994, here again in the early 2000s, the same effect happened. This time, though, the stock market says the economy is going to turn around. We said not a chance. Industrial production indeed turns negative there, as you can see on the chart, suggesting that the stock market is, even if it does rally here, which it can, and we made the case on Sunday, we could see a still higher surge in equity prices. The case, though, is over the long term, the bear market is coming back in a big way. And recent factory surveys has indicated tepid new orders, including the latest Fed poll of the New York manufacturers, which also showed growing concerns about the future. Looking ahead, factories will have to continue to weather cooling economic activity abroad, elevated interest rates at home, and an uncertain economic outlook. And you can only guess what that means that the factories are eventually going to have to do. If you said layoffs, well, you got it right. And one of the problems is the people on unemployment are unable to find a job, and that's an ominous sign for the U.S. economy. As U.S. continuing jobless claims now rise to the highest in almost 2 years, jumping for the 8th week to 1.87 million, this dragging initial claims higher. So this is very critical here, because when people lose their job and go on unemployment, the first thing to understand is their wages are going to fall because unemployment doesn't keep them at 100%. But if they can find a job relatively quickly, then it's not a major impact on the economy. But as people get stuck on unemployment because the labor market isn't as robust as the Fed tells us it is, then what happens is their discretionary spending starts to fall, and as more people back up on the unemployment system, more demand goes down. That leads to more layoffs, and what you see is initial claims will follow continuing claims higher. As continuing applications for U.S. unemployment benefits rose to the highest level in 2 years, underscoring the increasingly challenges unemployed workers are facing in finding new jobs, despite the fact that the job openings and labor turnover survey published by the government says there's over 1 million new jobs. Apparently, they're too hard to find for all these people on unemployment. Either that, or as we know, the government report is completely wrong. Recurrent jobless claims, a proxy for the number of people continuing to receive unemployment benefits, jumped to 1.87 million, ending the week November 4th. That marked the 8th straight week of increases. Meanwhile, initial claims also rose to 231,000 this week ending November 11th. That was the highest since August, validating the fact that where continuing claims go, initial claims follow. And sure enough, we have it here on this chart. You can see initial claims in blue, continued claims in red, and now sure enough, continued claims are continuing to rise as more and more people find themselves on unemployment and unable to find work. Well, as their demand exits the economy, well, that means initial claims head higher as more employers find themselves without the need for as many employees. And if the numbers trend sharply higher, that'd be a signal that needs to be noted. Well, it does need to be noted because it's very critical, but a single outlier reading like this time of the year is best ignored until or unless the direction of weekly moves start to consistently stack up in one direction. I have no idea, Stephen Stanley, how you could make such an outlandish claim. This is the holiday season. There's tons and tons of seasonal work. So the notion that some people can't find work tells us that the economy isn't as strong as it appears. It's not an outlier. This time of the year should not be a problem. If people want a second job or a part-time job on top of their job, or they need two part-time jobs instead of a full-time job, they should exist. The problem is they don't, because what we're finding out is retailers and wholesalers and everybody else overhired, and demand isn't there. That's exactly what Walmart's telling us. As Walmart crashes on disappointing guidance, warns that consumer spending is deteriorating. And here again, we warn that if the U.S. consumer fell apart during the holiday season, it would spell a disastrous first quarter, suggesting that we are likely to enter a recession in the first quarter of next year, if we're not, as some of you have said in the comments, already in one now. The increase in Walmart's comp store sales was notable because both Target and Home Depot reported declines in that metric this week as consumers continue to pull back from discretionary purchases. And what's notable here is that when people start shopping at Walmart, they're spending down. They're looking to save money. So when Walmart starts to do well in terms of same-store comparables over a period of last year, it tells you the economy is slowing. But even Walmart's not benefiting as much as you think. Not helping was the company's commentary on consumer strength, or rather weakness trends. According to the CFO, there was a sharper sell-off in sales during the last 2 weeks of October, kind of notably right before the student loan repayments started. Demand, however, picked up in November, spurred part by seasonal offerings. The takeaway for us is that we're seeing strength, we're seeing share gains versus others, but there's still pressure on the consumer. We're more cautious on the consumer than we were 90 days ago at this point. And you have to remember, a lot of these CEOs came out 3 months ago during the earnings day, we're optimistic. And we said, look, that's just unbridled optimism. They're just in a fantasy land. And sure enough, we're finding out the economy is indeed heading down. Separately, the company also warned that general merchandise sales reflected softness in discretionary categories, no surprise here, including apparel, home, and toys, categories which had expected would show a rebound, not something that rebounds when more Americans are on unemployment. And yet one expert says he's got it all figured out, this political elite, and we're going to show you he's got it all wrong. Larry Summers, former U.S. Treasury Secretary, says transitory factors behind inflation are now easing. He says the bottlenecks just push up prices. No, it was all about stimulus, shutting down the global economy, and then packing on monetary stimulus on top of that. Given how strong the economy's been, they're still surprised in what's happened to inflation, he said on Bloomberg. That is in part due to transitory factors that were pushing inflation up from bottlenecks that are now mean reverting and pushing inflation down. They weren't transitory in a sense, because what you saw is, again, fiscal stimulus, monetary stimulus, and a shutdown of the global economy, on top of the fact that a bunch of people retired because the stock market went up. Is that transitory? Well, some of it is, because we know people will come back to work. We know all of these things will start to normalize. The challenge here is he's trying to cover things up, because look at where he goes. He said he thought a lot about the slowdown in inflation that has ensued over the past year. The first key contributor he cited was tighter Fed policy. No, that was not tighter than expected. Larry, you got it wrong. They inverted the money curves. You know this. You're a former Treasury Secretary. You should understand this. When you curtail the credit creation of the economy, consumers can't spend. You want to know why they're not going to Walmart and Target and Home Depot? Because their credit cards aren't working anymore. It's simple. When inflation picks up, what do consumers do? They hit their credit cards. They go draw their lines of credit because they're hoping their wages are going to pick up. And what did they find out? The wages didn't. And on top of that, they got more debt. And then the Fed raised rates. It had all to do with the money curves, not how to do with how high rates went. Powell and his colleagues mounted the most aggressive increases in benchmark interest rate, which didn't matter. He said that doesn't mean inflation fears were unwarranted. No, it does mean they're unwarranted because the Fed didn't understand that we got inflation because we closed down the global economy and shoved money in people's pockets. And we cleaned off all the shelves. That's what caused it. It means that people took the fear seriously, which was good. No, that's not it, Larry. No. You got it wrong. People aren't taking the fear seriously because they don't believe it. They don't believe in the Fed. They don't believe any of that nonsense. What they do believe is what's in their take-home pay every month and what their bills are, and that's what changed. For the first half of 2024, the odds of recession are just 20 to 25%. He says, I'm going to go a whole lot higher than that. I'll say 75 to 100%. But there's been a little bit of prematurity in some of the declarations of victory. No, they haven't, because the surge in retail stocks this week on hopes that a recession is now off the table seem wise as a market response. But some people may have too much confidence in Mother Fed. Well, that's exactly what it is here, Larry. That part you got right. People think if you drop interest rates a little bit, spending will come back. It won't matter because the money curves will continue to stay inverted. But you know this, and I'm not sure the inflation figures over the next 2 years are going to be quite as favorable as the market is expecting. No, because the market thinks we're not going to have deflation, and we will, especially in the light of geopolitical risk around oil and some other commodities. But he did reiterate his concerns about rising borrowing costs. There's a very profound question of how long the world's greatest debtor will remain the world's greatest and most secure power. Well, Larry, I'll tell you what, as long as we remain the world's reserve currency, that won't be a problem. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.